Morning, ladies and gentlemen. Thank you very much for your time this morning. What I'm going to talk to you today about is a deep value proposition play that's going to be generational in value, but also generational in market. We're focused on nation building in PNG, but also having a resource base that can be phased and also provide the Pacific and into particularly the growing Australian market. As the front deck shows, the opening cover, we have focus on cement and lime, iron and industrial sands, and the energy and power generation sectors, all key critical ingredients in assisting a country that doesn't have anything of that nature. When I say doesn't have anything of the nature, let me paint a backdrop. PNG doesn't have its own clinker and cement facilities. So every bit of infrastructure that is built there is imported from Japan and China. The iron and mineral sands will be the first to have developed that, even though it's prolific over several hundred kilometres in the country. And from an energy and power point of view, some may or may not be aware that PNG only has 13% access to electricity, whereby there's a target to move from 13% to 70% in the coming decade that's funded by a significant amount of aid money. Let you read the disclaimer at your own leisure. So I think the key here is, firstly, as a corporate overview, share prices moved around here a little bit. I think it's sitting around 19 cents at the moment. But let me paint a backdrop why this is a opportunity for value investors. We listed at 40 cents. We've had highs of $1.10. We have a current market capitalisation of around 40 million. It's a little less than what you see on the screen. Yet we've spent $60 million in development. Now, some may say, yeah, but you could have spent that 60 million on projects that aren't that valuable. Well, the projects that we've spent on just phase one have circa 800 million of MPV in value. And all of these projects have been advanced. Those three verticals that I showed you have advanced to the point of DFS completed, permitting completed, including the environment permits. And we're now in financial discussions on debt and equity, as well as offtake. Now, I know KPMG has been used a couple of times. KPMG has actually been at the centre of arranging our funding plan and have been working with us for well over 18 months now. And we're very confident that we've reached a position whereby we'll be able to make some announcements in short order. So why invest in PNG? Now, what I want to do is separate fact from fiction. We're located on the coastline. It's not in the highlands. It's not 3,000 metres up. You can see the Orocolo Bay project, which is this project here, the Gulf Precinct. We've got the Central Cement and Lime project right next to the $18 billion PNG facility and the Lay Power project. Those three projects are all based on the coast with easy access. We have a very good relationship with the landowners there. So just going back to the why invest in PNG. PNG is a country that has a very, very strong affiliation with Australia. Some may or may not be aware, Australia puts $500 million a year in aid into PNG and will continue to do so. The strengthening bilateral relationship with the countries are increasing constantly. From our point of view, I'd challenge any other company to show how they've taken, since listing, 3 projects from concept, pre-feasibility, definitive feasibility, mining lease granted, full licensing and permitting, customer offtakes being negotiated, 3 major projects in the space of a 4-year period. So our objective now is we've done the de-risking. Okay, so the opportunity now is to see a major uptick. And when I talk about that, I'm talking about companies that are comparable in Australia that have EBIT multiples of anywhere between 16 and 20 times for industrial facilities. We're not thinking we're going to get anything near that, but I can tell you the current share price that we have is a shadow of that. Now, in saying that, I'll go back to this for a moment. I'm a trader as well. What do I look for when I trade and invest in a company? How much skin does management have in the game? You can see how much skin we've got in the game. Okay, recently management also just took up another circa 10 million shares on that 200 million. So if we didn't have confidence in the company, we wouldn't be actually taking on those liabilities. So now just getting into the projects and the way in which we're going to realise value for shareholders. We had a copper gold portfolio that wasn't core to industrial minerals and energy. That's already been spun out on the Canadian stock market. Our next focus is to spin out Maya Iron, which is under the brand of Autus Resources. Why are we doing that? Because we have a DFS that is valued at around 136 million US dollars using a $66 a tonne iron ore price. Now, so for all of you value investors out there, you know where the iron ore price is at the moment. We're planning to be in operations by the middle of next year, and we're expecting to get a lot higher iron ore price than that. Even if we don't get there, say it does drop back to $66 a tonne, which it's not going to, I believe. The reality is it's a great project. It is going to see more value as a pure play compared with its peers than sitting under a conglomerate. And that's the strategy we're deploying. There's also less dilution for Maya shareholders in doing that. We will then continue to unlock that in the cement and lime, and then go on and leave the energy portfolio, which is so strategic to the country's future, and without it the country will not progress. That will stay in Maya. So I'll skip over Additon because it is not core to the business. All I can say is with the Additon spin-out, existing Maya shareholders, probably up until the end of the year, will have the opportunity to secure the in-species distribution and be given the shares that we've secured. In that spin-out, Maya still had 43% of that new vehicle. Now moving on to Central Cement and Lime, as I've mentioned, this is a project of significant nature. It's PNG's first clinker and cement plant. So they're going to, for the first time, have a nation-building resource in their own country. You can see here, it's fully shovel-ready, mining leases granted, environmental permits granted. We're in the middle of negotiating offtake agreements for quicklime and also cement. We are going to phase the development with quicklime first, and I'll explain that reason now. From the perspective of attractive returns, you can see the capital cost. In phase one, however, the capital cost is 80 million. The 300 you see up as the ungeared and geared valuations is based on the full capital of the cement and lime being developed. Our objective is to get into cash flow first, and in doing that, from financial investment decision, we'll be in production within 18 months. You can see there, that limestone, it's literally, when I say it sticks 100 metres out of the ground with zero strip ratio, that's exactly what it does. So it's extremely low mining costs. We're looking to start with 200,000 to 600,000. We've actually pinned the tail on the donkey at 400,000 tonnes per annum. We're in discussion, as I've publicly stated before, with a number of parties to secure that. To give you some sort of understanding, a quicklime kiln for every 200,000 tonnes is around 10 to 12 million US in EBIT per annum. So we're looking to do 2 kilns in very short order. We already have the construction bids received, and now we're looking to credit wrap that with the offtake agreements. Once you have the credit wrap from the offtake, you've got the construction bids in place, you have the in-principle support from the commercial banks that KPMG have helped us with. What are you left with? Equity gap funding. That's when you go to the market and say, all my ducks are lined up. I'm now going to list this business. The equity we raise is going straight into the ground to build the facility. And that's what the plan is between now and Q1 next year. Just to give you an optical, the optical is quite clear. Cement and lime, cement and quicklime is being procured not only by PNG, which is a captive market for us in the future, but also by Australia from jurisdictions that are over 8,000 kilometres away. We're going to be 2,200 kilometres away. So when you look at that, just you cast your mind forward and say, does it or will it make sense for Australia and PNG to purchase 100% of all they need from these jurisdictions further away? The answer will be no. We're not saying we're going to take up the full allocation of demand in Australia and the Pacific. We likely will in PNG. However, the reality is it's only a matter of time before we end up providing that market. Now, my point in case is, see the light blue there? You can see from 2015, that light blue is Indonesians' clinker imports. See the growth of Indonesia into Australia. So half of Australia's clinker cement needs are being supplied by international importers. Why? Because there's not enough capacity in this country, nor will there be in the future due to cost and permitting for future clinker facilities. So you have an Indonesian backdrop that is really a blueprint of what's going to happen with PNG, which is even closer than what Indonesia is. So as I said, it's a matter of time. It's not if, it's when. This also shows a growing consumption of cement consumption in Australia, and we plan to be a part of that market share. This just highlights the value of quicklime. I'm just going to paint a quick backdrop on quicklime. What people don't realise is that we hear about this energy revolution, these green-facing metals. You're talking about rare earths, nickel and other things. What people don't realise is that for every extra tonne of nickel, you need the equivalent amount of quicklime. That hasn't flowed through to the market as yet. And that's reality. You can say that the market's going to triple in nickel production, but guess what? It's not going to happen unless you have the equivalent amount of quicklime to support that. So we see we're positioned in a very boutique space. Adelaide Brighton's business is hugely reliant on quicklime. Why last year in June did it drop by $500 million market cap overnight? Because there's an announcement that it wasn't renewing a contract with one of the major groups called Alcoa, and imported product from Thailand was going to come in. I've been to the facility, I know the company in Thailand, and we can get in just as cheap, if not cheaper, onto the west coast, and definitely far cheaper onto the east coast of Australia. From an environmental point of view, we have a very low carbon footprint. We have the ability on that site to produce a huge amount of renewable energy, circa 60 megawatts, far in advance of what we need for the facility. We're obviously going to need bankable baseload power also. At the right time, we will come out to the market and demonstrate how we are going to be net zero from production. None of this net zero in 2030 or 2050. We're going to demonstrate to the market how we're going to be able to do that from day one. So that's something that you should be keeping an eye on, because companies that are looking to procure product, will they procure product 6,000 kilometres further away with a carbon footprint, or something that's 6,000 kilometres closer with a net zero footprint that is just as cheap and as the same quality? Now, moving on to the iron. The iron, I'm just going to spend a short amount of time on this. We are going to be spinning this out before the end of the year. It's a vanadium titanium magnetite that has zircon and also a high-grade construction sand. We have multiple markets that we've got LOIs tied up for in Australia, in Japan, and also in China. We're converting them this year into binding offtake agreements. The funding is extremely small. You can see here, Oricolo Bay is the first. We've put our mining lease in. We expect an imminent grant on that. It's only a $21 million capex. Tiny. $21 million on an EBIT that is 25 million US per annum. So I repeat that, 21 million capex, 25 million EBIT at $66 a tonne iron ore price, not at the iron ore prices of today. Anything above $66 a tonne is above the 25 million US. So it's a fantastic project. We've already started the construction works with the camp. We have a shiploader in country. We'll be going out to the market. But what we're doing for Maya Resources shareholders, to be clear, we're actually looking at a couple of different debt pieces that is going to significantly reduce the dilution for Maya shareholders when we do list this, so we maximise value. Simple operation. It's digging at surface, spirals and magnets. You have your product. Very, very simple. It's going to be a barge loading system similar to East Kalimantan. I won't talk too much about this project. It's a vanadium titanium magnetite with emphasis on vanadium. And in relation to power, as I mentioned, 13% of the country is electrified. We're moving to 70%. We have a facility right next to a to the Ley area that has 60% of the country's industrial activity. Groups like Heineken, Coca-Cola, Nestle's, etc. The main use of power is heavy fuel oil. We're using a combination of thermal, solar, biomass and others. And as I mentioned before, at the right time we'll come out and discuss how we're going to be carbon neutral on all our products, including the energy that's generated from this project. This is just a schematic. We're negotiating with a power purchase agreement with the government. It's already had the environmental approval. We've secured the lease. So it's now just a matter of finalising negotiations with government. That's key management, proven track record across the board with multi-billion-dollar conglomerates. We're now moved out and doing this for ourselves, not for the majors. And so, we've put our money where our mouth is. Thank you very much for your time. Please visit the website and happy to have a discussion at the booth.